Hey everyone, a pleasant good morning everyone. Thank you for joining with us for the 101st tax talks. I have been hearing tremendous response from the participants too. A specific thank you to Surya Narayan sir for appreciating our efforts. So our intention is to deliver the tax fraternity, the GST community with sufficient knowledge to deal with compliances and GST litigation. So in that aspect, we thought for this week we have exclusive webinar on common credit reversal. You may wonder, as it is GSTR 990 due date is fast approaching on December 31, many professionals are seeking extension with respect to the income tax extension they have got. But to be very clear from our point of view, the income tax exemption was given because the utilities were released late. But with respect to GSTR 990, this is the first time they have issued the forms. They have enabled GSTR 990 filing on October 12, 2025 itself. So we are not looking an extension with respect to GSTR 990. So in that aspect, we have already had two webinars with respect to GSTR 9 and 9C. You can check it in our YouTube channel where our partner Arvind Tagam sir has dwelled upon the intricacies in filing GSTR 9 and 9C. Today, why we thought the concept of common credit reversal would be of utmost importance to the participants is because we come across many taxpayers who do not do common credit reversal on a monthly basis. They do common credit reversal only while filing GSTR 9 and 9C, which is not what the law has envisaged on taxpayers. But unfortunately, we come across many taxpayers who do the common credit reversal computation while only filing GSTR 9 and 9C, per se, the annual return for the financial year. So what is the setback when we reverse the common credit while filing GSTR 9 and 9C means the interest portion will be an extra cost to the taxpayer. So we should be very mindful of the fact, and I would advise everyone to do the common credit reversal on monthly basis if at all there is an exempted supply for that particular taxpayer. So on that note, I would will to start the common credit reversal concept. With respect to common credit reversal, many of us would have come across a notice saying that this is the TNGST departmental notices, where it is specifically have elaborated the provision of what common credit is about and asked us to reverse the common credit for the entire ITC that we have availed. So what they are telling is the formula for common credit reversal is very simple. Common credit into exempted turnover divided by total turnover. It is the exact formula for common credit reversal, which should be done via GSTR 3B on a monthly basis. But the department has issued notices for the financial year, previous financials also. Particularly, you have been dealing with the financial year 21-22 notices now, as the last date to pass order for the financial year 21-22 under section 73 is 31st December 2025. In that notices, many of us would have come across a specific point named common credit reversal. See, in many cases, the IIT notice, the scrutiny notices that the TNGST department gives is very, very properly articulated with respect to GSTR 1 late fee, because in many cases, the GSTR 1 late fee, what they have given is very exact, very accurate. They are not changing the due dates, because in 21-22 or 2021 previously, the due date was heavily extended due to COVID-19 pandemic. But the department has incorporated the extended due date and has been giving the correct notices with respect to GSTR 1 and GSTR 3B late fee. So, with respect to GSTR 1 and GSTR 3B late fee, there are multiple defects while giving the scrutiny notices. So, while giving the scrutiny notices, we can see many defects. One of the defects is common credit reversal. All other defects hold a approximately correct value. Of course, there is an allegation of ineligible ITC that we should check, and then only we should decide whether we should reverse or not. As I already said, with respect to GSTR 180, the calculation on the GST notice is pretty accurate. Seems to be pretty accurate in many cases what we have come across. But the big anomaly what we find with respect to the common credit reversal is they are taking the entire ITC what we have declared in table 4A of GSTR 3B. Table 4A of GSTR 3B is the gross ITC that we will declare on a monthly basis in GSTR 3B. Currently, after the inception of circular number 170, what we are doing is in table 4A, we are disclosing the ITC as it is in GSTR 2B. In table 4B, we are putting the reversal, and table 4C will be the ITC which will get carried forward to the electronic credit ledger of that particular taxpayer. So, before financial year 21-22, table 4A reflected only the gross ITC. Some taxpayers reflected the gross ITC net of credit notes. Some taxpayers put the credit note reversal separately in table 4B as there was no clear circular prior to the circular number 170 that was issued in July 2022. So, in that scenario, table 4A ITC contains the entire ITC of the taxpayer, not only the common credit. Be very careful of the wording. The wording given there is only common credit reversal. That is, see, you would have made a taxable supply in that particular period. You would have made an exempted supply in that particular period. You would have inverted taxable supply and sold a taxable outward supply. You would have inverted exempted supply and you would have sold an exempted outward supply. But there are some ITC with respect to which the ITC, mainly with respect to indirect expenses, the expenses are common with respect to both total turnover and exempted turnover, the taxable turnover and exempted turnover. The classic example of that is, say for example, rent, because you have a principal place of business through which only you do both the taxable supply and the exempted supply. In that scenario, the rent given for the building this, for the factory building or the office building or the head office building, whatever it is, that is for effecting both the taxable supply and the exempted supply. If we couldn't bifurcate separately the portion of ITC, portion of rent which is given for exempted supply. Of course, if we have a separate head office with respect to that particular supply which is an exempted supply in GST means there is no issue. But if you have a common head office for both, then there comes the term of common credit reversal under the CGST Act. But what the notices alleges, they are asking us to reverse the ITC on the entire ITC what we have declared in table 4A5 of GSTR 3B, which is the gross ITC that I have said earlier. So you should be very careful while replying to the notice, because we see many taxpayers have also appreciated the drafting of the notice per se, because in many cases the notices, because previously the notices were there were little errors in the notices, but now the notices issued significantly of this only with respect to scrutiny of returns. What I have already said, like GSTR 180, those are all seems very accurate. Whatever it is given in the notice, we are obligated to pay unless we take a very aggressive alternative view. But with respect to common credit reversal, with due respect, we wish to say that the common credit reversal given in the notice, alleged in the notice, is the total ITC given. There is no error on the part of the department in this scenario, because they do not have the common credit ITC, separate common credit ITC itself with them. So they have given only the entire ITC which we have claimed in GSTR 3B. So in that scenario, we should bifurcate the common credit ITC, because for affecting the taxable supply, if you have purchased any goods, that ITC is clearly eligible. Only the common ITC with respect to ineligible indirect expenses, what you have incurred, what you have accounted in your profit and loss account, that alone you should bifurcate, and that proportionately you should reverse the ITC as per section 17 subsection 2. So this is the first thing that we should note, because I'm also aware that the due date of financial year 21-22 is approaching. So if any notices are pending to be attended, please look into the matter that the common credit reversal ITC given entirely in the notice is not the common credit ITC, because that is what the information is available with the department. So they have given the entire ITC there, but we should only explain the reply saying that these are the common credits I have. So this is the proportionate calculation that they should do, and appropriately you should reverse the common. So the entire common credit reversal alleged in the notices should be carefully looked upon before making a payment with respect to this in the financial year 21-22 notice. This is with respect to the notices that were issued previously. Of course, in the current year also, while filing GSTR 9 and 9C also, be very mindful of the fact that you are reversing the common credit reversal ITC, because many taxpayers would not have reversed the ITC month-wise because they are not very sure of the calculation, so they would not have reversed the ITC. Of course, they would have taken the ITC, the entire 2B and 3B would have matched, but if there is an exempted turnover, be very mindful of the fact that the common credit reversal part will attract late reversal of common credit. Would result in additional interest, which will be a cost to the assessee. So in that note, we will just see what is exempt supply and how the calculation should be made. So what is exempt supply? The exempt supply given in the section is act is the transactions which are wholly exempt from tax. For example, electricity generation, interest from banks. For that all, GST won't be charged, but because it is wholly exempted via exemption notification. Then nil rate of tax. Currently, nil rate of tax, there is no good separately with respect to nil rate of tax, but the definition specifically terms the word nil rate of tax. Then the most important thing is non-taxable supply. So even with respect to supplies which are not taxable under the GST, for example, petrol, diesel, those are taxable under VAT regime still. So even in that case, if you have a common credit reversal, you should proportionately reverse the ITC. That we should be very mindful upon. So the next thing is section 17 subsection 2 only talks about the common credit reversal. So the proportionate reversal of ITC should be done only with respect to exempt supply. In this regard, we should be very careful while calculating the portion of exempt supply, because zero rated supply, that is supplies to SEZ or exports, will not be treated as exempt supply for this specific computation. So I give a numerical example to give a better view of this in coming slides. So the most common expenses with respect to which attract common credit reversal is, as I have already said, rent. The other thing is audit fees, because while a statutory auditor or an internal auditor does some audit and charges professional charges from you, it is for the entire organization that they do. They do not specifically do statutory audit for the GST taxable supplies and the GST exempted supplies. They do statutory audit or internal audit for that matter for the entire organization. So if there is audit fees, it will form part of an indirect expense in the in our profit and loss account. So for that also, common credit ITC, proportionate ITC should be found and should be correspondingly reversed. Telephone charges will also be very common. Maintenance expenses, building maintenance expenses, it might be a vehicle maintenance expenses. So eligible vehicle maintenance expenses, in that vehicle itself you would have done taxable supply also or effective exempt supply also. So in that scenario, you please take note of what are all the expenses that are in exempt supplies. With that expense, you do a proportionate ITC reversal and then do common credit reversal in GSTR 3B in every month. So I thought I'll just give a basic numerical example to be on the same boat on what common credit reversal means exactly. First thing is, assume a registered person has taxable domestic supply rupees 6 lakh, zero rated supply, export supply, if it is with payment of tax with the LUT, that doesn't matter. With the LUT means I have given a specific clause with the LUT, because with the LUT we will not pay any tax. Even then it will not be considered as exempt supply. So for that, including that scenario, I have given specifically exports with the LUT. For whatever exports it may be with payment of tax with LUT, it will not form part of exempted supply at all. So taxable domestic supply is 6 lakh. Zero rated supply, exports with LUT or SEZ supplies, that is 4 lakhs. Exempt supply is 2 lakh. The total turnover 6 plus 4 plus 2 lakh is 12 lakh. Input tax credit. As I already said, here we should not include all the inputs that are given in the that we are going to avoid in the month. We should include only the ITC with respect to common inputs and input services used for effecting taxable and exempted supplies. If we cannot bifurcate clearly, then only we should do a common credit reversal. Because if you do straight away a taxable inward supply for taxable outward supply, that ITC is fully eligible. If you do an exempted inward supply and do an exempted outward supply, there will not be no ITC, there will not be any ITC in the exempted inward supply itself in the first place. If you are doing a taxable inward supply and specifically you are using that for an exempted outward supply, in that case also, with respect to the taxable inward supply, no ITC should be taken. Only if we are using an expense for effecting both taxable supplies and exempt supplies, then only there will be a situation where common credit reversal would be required to be done at Form GST 3B, monthly return that we are going to pay. Today is the due date of Form GST 3B for November GST 3B. So while filing GST 3B, you should do a common credit reversal for that particular period. So in this example, ITC is to be reversed. See, exempt supply, what I have given is 2 lakh. I have specifically not included 4 lakhs because this is the zero rated supply also done without payment of tax only, but that will not get included in this exempt supply definition. So 2 lakh divided by total turnover 12 lakh. So I am taking only 1,20,000 ITC because that only came in the that only came as accumulated as common credits. The entire ITC for that organization for that period would have been 10 lakhs, but I am not taking 10 lakhs here. I am taking only the portion which is commonly used for effecting both taxable supplies and exempt. So this is the formula: 2 lakh divided by 12 lakh into 1,20,000. So 20,000 is the ITC which we should reverse via GST 3B. This we should be very careful upon while doing the common credit reversal calculation. This is the most simple calculation and this is the most frequent calculation that is done, because in many cases there will be exempt supplies, there will be taxable supplies, and there will be common credit which can be easily bifurcated upon seeing the P&L expenditure itself, indirect tax expenses itself. So this is the simple, very simple calculation with respect to common credit ITC, unless we have some peculiar non-recurring transactions. This is the regular calculation. What we do generally is we have a separate sheet called common credit reversal in our GST 3B working sheet, where for every taxpayer we will check on every tax period whether if they have any exempt supply, and if such exempt supply will specifically attract common credit reversal under section 17 section 2. So while filing GST 3B of every month, we should do a common credit reversal in on that with the values corresponding to that particular month. So the next thing is, what are the supplies which should not be taken as exempt supply? I have already said that you should not take into account the export transactions as a part of exempt supply. Even though it is supplied without payment of tax, you should not include it in the computation of exempt supply for the purpose of common credit reversal. So what are the other common transactions which should not be included in the exempt supply turnover? Because if the exempt supply turnover is more, the common credit reversal will be higher. If the exempt supply turnover is less, the common credit reversal will be relatively lower. So in that scenario, it is very important to know what is exempt supply. Besides what is exempt supply, what are the exempt supplies that should be included while calculating exempt supply, and what are the supplies that are to be excluded while calculating the exempt supply. First and foremost thing I am willing to tell is Schedule 3 transactions. Schedule 3 transactions, we come across many things such as Schedule 3 to the CGST Act is a separate schedule which talks about transactions neither treated as supply of goods nor supply of services. So it is not a supply itself in the first place. That is what Schedule 3 talks about. There is 8 paras with respect to Schedule 3. Mostly employee-employee relationship. If a salary is given, it is not a supply. If bonded warehouse sales is done, that is not a supply. If high C sales is done, that is not a supply. So these are the transactions which should not be included in exempt supply too. Except sale of land and building. Sale of land and building alone in specific circumstances, we should be obligated to include in the exempted supply. Other than that, per se, the Schedule 3 transactions will never come in the purview of exempt supply because it is not at all a supply itself in the first place. So we see many taxpayers getting confused on whether if they do high C sales, if they should do any common credit reversal. They do any bonded warehouse sales, if they should do any common credit reversal, they are all covered under Schedule 3 transaction. So common credit reversal question will not come into that for that scenario. The next most important thing and most common thing is interest on deposit. Of course, if we have every proprietorship concern who has a GST registration has an FD in their name or with respect to savings bank, they will be getting an interest. From that interest is not GST chargeable because it is specifically exempt by the exemption notification given under GST. That should not be included in the exempt supply turnover. So see the other income column. In all the concerns, I am very sure in the other income column there will be an interest portion which will be included in the other income. For that. The common credit reversal need not be done because there is a specific exclusion in the law to say that interest on deposits need not be considered for the common credit. The next important thing with respect to people who export, taxpayers who export is duty credit slips. See, once they export garments, they will get a duty credit slip called ROSETL. Once they export other goods, they get a duty credit slip called RODTEP, which is commonly referred to as ROT. So that duty credit script will be ultimately transferred to a person who has some import duty and some value will be realized, which will mostly go to the indirect income of the P&L account. So for that value of duty credit scripts also, previously there was a anomaly between the GST law and the taxpayers, but after 2022, it was clear to say that if you have sold any duty credit scripts, that value need not be included for the purpose of common credit reversal. So these are the three very common things for which common credit reversal, the question of common credit reversal might come, but the common credit reversal need not be done. So predominantly we see many taxpayers have interest on deposits for that. So for the names, if the exempt supply is given, we need not straight away go to do the common credit reversal. You please check what is the common credit reversal, what is the exempt supply that we should include in the common credit reversal, and then proceed to do the reversal under section 17, subsection 2. So, common credit reversal with respect to capital goods. There are two things here. One thing is common credit reversal with respect to inputs and input services. There might be a situation where you buy an input, where you buy a raw material for affecting both taxable supplies and exempt supplies. There might be a situation, there will always be a situation where you avail an input service, what we have seen, indirect expenses, rent, audit fees and all, for which you have used for affecting both taxable supplies and exempt supplies. There is also a third scenario to say that there might be a machinery or there might be a plant which will be used for producing both taxable GST goods and exempted GST goods. In that scenario, the first thing we have to do is, because while purchasing the raw material, we will be very sure that the raw material in every industry it will get sold. Ultimately, it may get processed or it may get sold as such within the next 6 months of the cycle. But in case of capital goods, we all are aware that we use capital goods for a very longer period. While purchasing the capital goods, we will not be even aware of the exact ratio on, for example, for 5 lakh rupees, you have purchased a capital goods. You are not very sure how much taxable supply will be done through production of that machinery and how much exempted GST supply will be done through production coming from that machinery. You will not be very sure. So the first thing what we should do as per the act is you should avoid all the ITC with respect to capital goods once you have satisfied all the conditions with respect to Section 16 of GST Act. That is, you have received the machinery, the ITC is correctly reflected in GST Act 2B. The supplier has paid his amount via GST Act 3B. You have paid to the supplier. If all the conditions are satisfied, then you proceed to avail ITC when these all conditions get satisfied. For example, in December 2025, you are purchasing a machinery. From Jan, you are going to produce goods with that machinery. In December 2025, while filing December 2025 GST or 3B return, avail the entire ITC with respect to capital goods. In our example, say for example, 5 lakh is the ITC with respect to capital goods. Avail the entire ITC of rupees 5 lakh in December 2025. Then, for next 60 months, that is for 5 years or up to the date of sale of machinery, you should do proportionate calculation and you should do the exempted portion. You should calculate the exempted portion separately and you add it to the output tax liability. For example, you have availed, for the sake of easy understanding, I will go with a very easy figure. For example, you have availed 6 lakh ITC with respect to capital goods in December 2025 GST return. That is the total ITC available with respect to the machinery that you have bought in December 2025. In January, what you should do is the GST law assumes the life of capital asset to be 5 years. 5 years. So in Companies Act it is different, in Income Tax Act it is different. The taxpayer himself might say that it will come only for 3 years, but the GST law only recognizes the period of 5 years, so which is 60 months exactly. In that scenario, what we should do means 6 lakh divided by 60,000, 6 lakh divided by 60 months, 6 lakh divided by 60 months, which will come approximately to rupees 1,000. That you should proportionately reverse. Assume in 1:1 ratio, you have done taxable and exempted supply in Jan 2026 period. In that scenario, 1,000 into 1/2, 500 rupees you should add to the output liability. The main thing what we have to note here is the 500 should be paid back with interest, because the section specifically tells that it will be added to output tax liability with interest. So we will always advise the taxpayers to avail the ITC for the next 60 months instead of taking the entire ITC of rupees 5 lakhs in the first month. You avail the ITC proportionately. That is what we say, but we should also be very careful of the fact that there is a provision, section 16 subsection 4, time limit for availing ITC, which says that whatever ITC is there, you should take for that particular period, you should take within the next November 30. For example, financial year 25-26 ITC, you should take within November 30, 2026. So, or else you please don't utilize that ITC, capital goods ITC. You keep that in the electronic credit ledger itself, because if at all you have utilized that ITC, then as per section 50 subsection 3, you should pay back that ITC with interest. Every month you should pay back that interest. So with respect to capital goods also, common credit reversal is there. So please be mindful that for input services, capital goods, for all the three, if there is an exempt supply, except the exempt supplies, what I have specifically told, if it is there, you should be very mindful to do the common credit reversal in that GST or 3B itself. So where we should report the common credit reversal? We should report it in 4B1. We all know that 4B1 is the permanent reversal with respect to block credit. The ITC block we will ideally report in 4B1 of GST or 3B. The same Rule 42 and Rule 43 also, which talks about the common credit reversal with respect to input and input services. The other Rule 43 talks about common credit reversal with respect to capital goods. All that are to be shown in table 4B1, not table 4B2. We should not do it in table 4B2. Table 4B2 talks about temporary reversal. which you should, which you are eligible to claim again. But in this case, you cannot claim again itself. If you are opting for a view to say that you are not availing the capital goods ITC in the first month itself, then only the reversal question comes into place. Otherwise, the whatever the exempted portion that you calculate with respect to common credit reversal, that will be added to your output tax liability. So, what are the events that you should be very careful to know that the taxpayer has a common credit reversal? If he has reported anything in table 8 of GSTR 1, table 8 of GSTR 1 talks about related, exempted and non-GST outwards. So these are the things that table 8 of GSTR 1 talks about. We have a, while performing GSTR 990 reconciliation also, we have a separate table called GSTR 1 summary in the annual return tab. You please see that if there is any figure in table 8, please ask breakup for that figure. If that figure should form part of exempt supply, then they should have done a common credit. So please be aware, if there is a reporting in table 8 of GSTR 1, then common credit reversal will be mandatory. The other thing also, even if it is not mandatory, even if there is a circumstances where the taxpayer has got only interest amount, then you please make a separate note in our working papers. Tax professionals are saying it. You please prepare a working papers, or whoever filing GSTR 9 and 9C, you please make a separate working note to say that it is interest only, so common credit reversal is not required. You please make a separate note. So we would be aware that we get checked with respect to common credit, because we are all aware that 21-22 notices comes now. Similarly, 25-26 notices, 24-25 notices will come in 27-28-20. In that, when that comes, we should not be in a dilemma to say that whether we have correctly checked it or not. So you please make a separate note. If there is some reporting in table 8, you make a reference to it and give a bifurcation on what is the amount, breakup of the amount contained in the table 8 of GSTR 1. And you decide whether common credit reversal as per the law is required or not. Another thing is reporting in table 3.1 C or 3.1 E of GSTR TV. So corresponding entry with for table 8 in GSTR 1 is table 3.1 C or 1 E of GSTR TV, other outward supply, non-GST outward supply. So in that scenario, if you are reporting anything, please make sure the common credit provision will be attracted. Then, with respect to GSTR 9, in table 5, in GSTR 9, table 5D, table 5E, table 5F talks about supplies which do not attract GST. So, if there is so many notices comes from this point only. So, in 21-22 or in previous years, if we had reported any amounts in this table 5D to 5F, then only the allegation of common credit reversal comes. So while filing GSTR 9 and 9C also, you please double check whether the reporting there, whether any reporting is there, and if at all any reporting is there, it will attract common credit reversal. The corresponding entry of table 5D to 5F of GSTR 9 is table 7 of GSTR 9. So in table 7 of GSTR 9C, the taxpayer is obligated to disclose separately the exempted related to non-GST supply. If he has entered anything in table 7B, then also we should be very careful on whether common credit reversal will be applied. So the most common questions with respect to common credit reversal is common credit reversal need to be done on entire ITC. The proportionate workings need to be done on entire ITC. I have already addressed this. Common credit reversal need not be done on the entire ITC. Common credit reversal only need to be done on the common credits that are used affecting affecting both taxable supplies and expenses. So on entire ITC, a very big amount will be calculated if we calculate it on the entire ITC. With respect, only if you take the indirect expenses ITC and calculate, it will be a very small amount if we reverse it every month. So please make sure that the common credit reversal is not calculated on the entire ITC. Another thing is, I have brought the split sale, which is generated as an export benefit. Should I do common credit reversal? No. If we have a rotten script sale, as we have already said, script sale is specifically excluded from calculation of exempt supply. So, common credit reversal in that aspect is not all required. Third and most important question, which we often come across is, many people, many spinning mills, many industries have a windmill through which they generate electricity and entirely consume it through captive consumption. The catch here is, for the purpose of 80IA exemption in the Income Tax Act 1961, they would have given a proportionate figure in income and they would have given a proportionate figure in expense also. In that scenario, the income what we have reported for that, it is alleged that we have to reverse common credit. In our personal opinion, if you are doing entirely captive consumption, that is, if we are not doing a third party sales, electricity third party sales, then common credit reversal is not required because it is not an income itself in the first place. It is only a book entry for 80IA, so it is not required. But the department may take an aggressive view because this question specifically we have come across with respect to many spinning mills where the officers are of the view saying that once an income is reported, that is exempt income, for that you are not paying GST. So for that, whatever expenses you have claimed, you should do an ITC reversal and you should also make a common credit reversal. So that is the argument of the officers. But in many cases, our wealth tax team has successfully elaborated to the officer to say that why common credit reversal logically itself will not come in this scenario. So if we accept common credit reversal for that, then we are also accepting the ITC reversal for which the windmill parks, if we have any AMC with respect to windmill, or if we have purchased the windmill, for that also you cannot claim ITC. So once you accept the common credit reversal, you are also accepting that too. Even if you are not accepting in the same notice, if you are marking your grounds in the notice, it means that if you accept the common credit reversal, you are accepting that AMC reversal also, ITC reversal also. So that should be strongly contended upon. So the next thing is, common credit reversal need to be done yearly? No, common credit reversal needs to be done every tax period. If you are filing monthly returns, monthly, you should make a common credit reversal if there is an exempted supply. If there is a quarterly return, if you are filing quarterly returns, quarterly you should make a common credit reversal. So that is what, with respect to common credit reversal periodicity, nowhere in the law it is given that we should do the common credit reversal yearly, but practically in many circumstances we see many taxpayers doing common credit reversal while filing GST and 9 and 9C only. In that cases, there is a chance of attracting interest with respect to whatever ITC we have reversed now. We should be mindful upon that. The last thing is, will the inception of GST 2.0 trigger common credit reversal? Because of in September 22, 2025, GST 2.0 has been introduced. Drastically, many GST rates have been reduced to 12% to 5%. For some goods, it has been made exempt also from taxable to exempt. For that goods, if you are purchasing a taxable, if you are while purchasing it, if it was a taxable good, and if you are selling it as an exempted good, of course, common credit reversal will be exempt. Common credit reversal will attract. Otherwise, only for the reduction of rate, common credit reversal will not attract, because common credit reversal is specific for exempted goods and not for the rate reduced goods and all. So we need not worry about common credit reversal. The rate is only reduced. So this is all with respect to common credit. This is a very small and niche topic. As we already said, why we thought we should dwell upon us. Many taxpayers do this common credit reversal in GST while filing GST or 9 and 9C only. For the entire year, they do common credit reversal. So I request everyone, because as yearly we do the common credit reversal, it is better because we are foregoing the interest portion as yearly we do. So please make sure that while filing GST or 9 and 9C, common credit reversal calculation is also forms an integral part of your calculations. And with respect to common credit reversal, if there is any doubt, feel free to reach out to us. Also, in many cases, many professionals or taxpayers also have a doubt to ask that, because we thought to have this webinar particularly during this period because in the past 2 months we had many queries with respect to common credit reversal alone. So if you have any specific queries, feel free to reach to us. Simply doing a common credit reversal alone will not entitle you for a correct filing or a penalty list compliances. It is also to be borne in mind, the common credit reversal should be very accurate, and whatever you have reversed now, you should be able to demonstrate it with the correct calculations in the future years. Because as we all know, there is not a separate column called common credit reversal in GST or TD itself. There is only a 4B1 table which also includes common credit reversal along with the ineligible ITC, what we will reverse for, ideally for the block, for example, food and beverages we got, vehicle maintenance we got, and for that and all, what we will enter in 4B1, the common credit reversal gets also included in that part. So please make sure while making a common credit reversal, you have a correct calculation with respect to it. In future, you will be definitely called upon to prove what calculations we have made to do the common credit reversal. So I will just quickly go on to the questions. Surya Narayan sir, thank you very much for your continuous support and your kind words. Thank you. Dealer purchased vehicle to shift sugarcane and sugarcane juice maker and its ancillary. In such case, what is the simple formula to find related ITC reversal, sir? Sir, proportionately, we should reverse the ITC, sir. In purchase vehicle, we will be treating it as capital goods, sir. As per Rule 43, we should avail the ITC of capital goods in the first month itself. Then, month on month, you should put, for example, sugarcane is 5 lakh turnover and sugarcane juice maker is 3 lakh turnover, means you should do an ITC reversal divided by 60. Assume, as I already said, 6 lakh is the vehicle ITC what you have got. 6 lakh divided by 60 into 3 lakh divided by 8 lakh. So that is the ITC you should get. It should get added to your output tax liability every month. That you should do also with interest. So roughly it will not work because, as I said, the department or whoever person audit or inspection, whoever it comes, they will definitely ask for a calculation with respect to which you have done a common credit reversal. So it would be better if you could do it based on turnover instead of an assumption basis. Can I get GSTR 1 and GSTR TV template? Yes, sir. Sure. Sir, how can a taxpayer can enroll in ZenTax? It takes us as a taxpayer. There's no option to click tax practitioner or GSTP. Surya sir, you please give me your number. I will ask my portal team to coordinate. Sir, should we do common credit reversal for sale of land and sale of agricultural product? Yes, sir. Sale of land, in some cases, it is to be done, sir. Export samples ITC reversal, where we need to show in GST TB. So this is not relevant to the topic, but it should be done in 4B1 only, sir, because forms part of section 16, subsection 5 of the GST Act. So it should be done in 4B1 only. Domestic sample we are sending through tax. So what will be the impact IMS and customer view? So again, this is not the topic relevant to this. So domestic sample, if you send through tax invoice, you should ideally put a credit note only, sir. Otherwise, you should pay the tax and you should he will ultimately the customer will claim credit only. I have one question in GST. We have reclaim reversal in others in 4B. That should be where in GST 9. So I think you asked about the reclaim column GST 9. It is table 6 sketch of GST 9, sir. As I already said in our YouTube channel, our partner Arvind Tangam has clearly demonstrated on in which column, which aspect should be filled with a prototype of GST 9C itself. So you please check on that, sir. Sir, okay, noted, sir. I will ask my team to call to you, sir. Thank you. Which goods or services covered under common credit reversal? Sir, that's what we spoke about till now, sir. Commonly, it is for windmill. If they have windmill, common credit reversal would be attracted, sir. If there is a non-GTA road transport, common credit reversal would be attracted. So whatever is it is exempted supply, whatever exempt supply is given in IT statements or GST returns, you please check on what is the exact breakup of that. Yeah, Divya, madam, thank you very much. We had a poll too, actually. I think many of us voted it. Thank you. How do you usually handle the common ATC reversal process in your business? I'm very happy to know that many of us, are almost half of them, have a clear system in place and follow it regularly. Relying on professionals is also it's a very good thing, not at all an issue. People who couldn't find the exact common credit reversal and only reverse it when notices are issued, please be aware that the interest portion, we cannot forgo that interest portion. If anything, you please can reach out to our team with respect to common credit reversal, and you let us know. We will do the exact calculation and our team will do it. Yeah. Thank you very much. I know this the GST are due date. In spite of that, I'm very happy to receive an active participation from the participants. So this is the last week we have completed our 100th tax talks. This is the 101st tax talk. We are very privileged to have continuous support and continuous engagement in the participants. They are also actively asking for topics. So I thank you wholeheartedly from our Fintech team. Very thank you, and have a pleasant filing with respect to GST 9 and with respect to GST 3 today also. Have a very pleasant filing. With respect to 2021-22, if there is any notice, you can reach out to us. Regular followers of our Fintech training would know our portal where you can enroll, and it is free to use. You can track the notices, because we all are aware that for many taxpayers, notices are redundant. Again and again, the same notices are appearing. With respect to that, we have a platform in the tax clinic where you can, once you upload the username and password of the taxpayer, you will get all the notices, which are all notices pending to be replied, pending order to be given by the department. If any notices, any help is there, you please reach out to us. We will, because please note that we should follow with the department to get the notice, to explain our facts and drop the case, because we come across many department officials also. They have many notices to dispose within a very short period of time, because 31st December, the last date to dispose the 21-22 notices with respect to section 73. In that case, they have bunch of notices. It is impossible to read each and every sentence of the reply and give a correct judgment. So we would everyone, if you have any pending notices, you can reach out to us, or you yourself go to the department and explain to the officer what is the exact issue there and what reply you got given, and get the appropriate order from the government officials. Yeah. So thank you very much. The next webinar will mostly be next Friday. We'll just thank you.